Okay, so we're going to talk about open market operations in monetary policy. And now, why are open market operations so important? Well, they are the most effective tool the federal bank has in regulating the ebb and flow of our economy through monetary policy. And so that makes it very important. So, an open market operation is when the feds use the buying and selling of treasury bonds, which are U.S. government debt, basically, to curb the amount of cash that banks have on their balance sheet. So, let's say a bank is low on cash. That's going to mean that the bank is less willing to lend out that money because it's more risky for them to have less money on their balance sheet. So, if banks don't want to loan out money as much, the interest rates on those loans are going to be much higher. And if the interest rates on the loans are much higher, people aren't going to want to take out loans. And when people don't want to take out loans, people don't want to start businesses. People don't want to buy cars. People don't want to do anything that costs money because they don't have money. The banks have the money, and they don't want to give it to them. So, let's say we could somehow give the banks more money. This would mean the interest rates would be lower, and then this would mean that the banks would be more willing to lend out money. And if the banks are more willing to lend out money, then the interest rates are going to be lower, and people are going to be more willing to take out the loans, and they're going to be more willing to start businesses and buy cars and spend money. When people spend money, the economy gets going. So, we want the banks to have more money, but how do we do it? Well, the Fed has the perfect opportunity here, because the Feds know that all banks carry treasury bonds, and what they want to do is replace those treasury bonds with cash. So, if you've ever traded on the stock market, you'll know that when the price is right, people will sell whatever they have. So naturally, the Fed offers extremely high amounts of money compared to the market price for these treasury bonds to the banks, and obviously the banks are going to take it. And when the banks take the cash, the aforementioned process takes place where the interest rates lower, people start spending more money, and the economy gets going. So, in loose money or expansionary monetary policy, the Fed is going to buy a whole bunch of treasury bonds from the banks. That's going to replace the treasury bonds on the bank's side with cash, and that's going to kickstart the economy. Now let's say there's too much inflation. You've done too much buying, which is usually what happens. Now the bank is going to have too much cash, and they're going to have extremely low interest rates, and it's going to cause inflation across the board. And we don't want that either. We want to be cruising at a nice 60-mile-an-hour rate with our economy, if you know what I'm saying. So what we're going to have to do is we're going to have to take some of that cash off the bank's balance sheets. So, again, if the price is right, people will buy. Just like if the price is right, people will sell. So the Feds want to get rid of some treasury bonds now and give them to the banks so they can take some of that cash away from the banks. They're going to offer an extremely low price for their treasury bonds, so the banks are going to want to buy them. The banks do that, and before you know it, they have a whole bunch less cash. And now interest rates are starting to go up. And now people are less willing to take out loans, and your inflationary problem is solved. These are the two types of open market operations the federal bank will participate in monetary policy. And it's not to say that their other tools are less effective or anything, but, well, it kind of is. Because open market operations is really how the Fed does their monetary policy stuff. And it's the most important part. And I lied. So that's it.